We're also watching interest rates. We're up to 3.10 on the benchmark 10-year yield. So that's up a couple of basis points today. And while we talk interest rates, let's bring in the former BB&T Chief Executive Officer, John Allison. And John, it's good to see you on, the thought here about what rising interest rates really means. I mean, we talk about it in the context of the stock market all the time. Some people say we get to a certain point and we're in trouble. Even that's why we were in trouble the last couple of weeks. But what is your general impression before we dig into it of rising interest rates and this environment we're in?
Good afternoon. I think the market and the economy to some degree has largely discounted the interest rate rises that the Fed anticipates making. The real issue is where the rates rise faster or higher than people expect. And I think the long-term challenge there, and it's not that long-term, is rising interest rates are going to raise government deficits, and they could raise them materially because the U.S. government is the world's largest debtor, and you could potentially have $300 to $500 billion annual increase in deficits, and that's going to both rattle markets and it's going to impact the economy. So short term, I don't see the impact being much different than we've already seen. Longer term, it's a challenge.
A couple things there. I mean, they get into the president's criticism of the Federal Reserve, what that has meant, how the Federal Reserve will react not only to that, but the data of last week. But let me follow up on the deficit point, John, first. What's your timetable of worry on that? When do you think the red flags, the red lights start flashing on the deficit issue if they haven't already?
Well, for me, they've been flashing for several years, so it's, I'm not sure what.
Maybe for the markets,
I'm not sure why the market hadn't.
Yep.
Yeah, I would guess within the next year, if we start seeing the actual numbers and rates get higher and stay higher, it's going to be hard for the market or the economy to ignore the implication of a much more expensive level of debt in the U.S. economy.
All right, over the next year. Yeah, I mean, and you're right. Your guess is as good as anybody's because people have your point of view, think that somebody should have been thinking about this years ago as opposed to a year or two down the road. You're absolutely right about that. Let me ask you about the Federal Reserve's reaction, though, because that'll obviously play into all of this. There's kind of a couple of schools of thought. The president's gone after the Fed. He got after Jay Powell, the chairman of the Fed, and been very critical of the rate of increase. We had a discussion on some of our shows last week where some people said, you know what? Jay Powell, if anything, reacts to that by saying, I'm going to keep raising rates. Maybe even won't say this, obviously, but I have to prove in my mind that my Federal Reserve and this Federal Open Market Committee is independent to criticism from the president or anyone else. In other words, the president's criticism might have the opposite of what you think would be their desired effect. Others look at it and say, in the data last week, you can find some reasons that the Fed kind of can slow down a bit and not be as aggressive. What do you think will happen?
I think that the president's comments will have basically no impact. I think the Federal Reserve will go by their own models, and so I don't think that his comments will matter. Now, the Federal Reserve is a very political organization in a long-term context. First, everybody has to be recommended by the president and approved by Congress, so you have a lot of politics in the process, but probably not in reaction to some kind of immediate comments. What's really interesting. There are a lot of economists that focus not just on interest rates, but on what's called nominal gross domestic product, NGDP. And if you look at the NGDP, the Fed's actually been very accommodative, and more accommodative than it was during the economic correction. So one of the interesting issues is are they already being accommodative? And really what they need to do is raise rates and actually slow the growth of the money supply.
Be careful, John. You might get yourself a tweet for that pretty soon if you're advocating for higher interest rates. Thank you so much for coming on, though. You're right. That is interesting. It's good to see you, John Allison.